What's up, everyone? It's Scotty with Money Vesting. So, wanted to break down a couple of reports on the state of the U.S. consumer and also retail sales that we got last week. So, there was a report and a survey done by Deloitte, and then I also want to break down the expectations based on the options market for where inflation is headed 5 years from now. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. And we'd love to have you on board. We've got a little bit over 3,700 members talking about fundamental analysis, technical analysis, macroeconomics, and stocks and options as well. And you'll also get access to all the buy and sell alerts, options alerts, trade ideas, everything included with that 16% annual discount that does expire at the end of this month. So this right here is the report that State of the U.S. Consumer March 2023. And the key insights about the U.S. consumer from Deloitte's State of the Consumer Tracker is that the percentage of Americans surveyed concerned about their level of savings, 44%, so almost half the consumers that were surveyed are concerned about their level of savings, because savings rate obviously has come down to extremely low levels, and it's actually even lower than pre-pandemic levels. And 43% of those are actually delaying large purchases and decreased significantly since the summer of 2022 when inflation had touched record highs. As inflation continues to ease, slightly fewer consumers surveyed have reported feeling anxious about the direction of the economy. However, Americans surveyed remain cautious as concerns around rising prices remains elevated, and spending intentions for the month ahead remain relatively weak compared to 2021. This is a really important piece here because future spending expectations have been coming down. So you can see that in recent months, consumers surveyed have signaled intentions to save more and spend less. That is definitely a bit of a concern. And the problem why that is so important is because earnings are directly correlated with spending. And even though retail sales was up in January, it's been down consistently for 2 months, February and March, and I'm surprised it's not being talked about enough. One of the things that I have mentioned in my previous videos is that consumers are definitely coming up against a very challenging time because not only interest rates are higher, so cost of borrowing is higher, but we also have inflation, right? So prices for goods and services are also pretty elevated. Savings rate are at a rock bottom, right? So we are lower than pre-pandemic levels. So on one hand, you've got more expensive items. Wages have not been growing at the same rate as inflation. In fact, wages are trailing behind, price inflation for quite some time. I think it's like 20 or 24 consecutive months where average hourly earnings have grown at a much lower rate than compared to inflation. And of course, you got cost of borrowing going up with interest rates going up. So the debt servicing cost is also going to increase, and eventually there's only so much money that can be going around, and the excess savings are going to continue to deplete, which is obviously going to be a problem for the economy. Now, I want to be very clear. Just because it's a problem for the economy doesn't mean it's a problem for the market. Those are two very different things. Those are completely disconnected with each other. What may be bad news for the economy might end up actually being good news for the market. We'll touch on that later in the video. But if you read further into this report, concerns around rising prices remains elevated. So, people still expect prices to remain as high as they are, remain elevated. And this right here is the personal savings rate, which has steadily been going up since June of 2022 as people are now more focused a little bit on saving more money as opposed to spending. And we are still way below the pre-pandemic levels. We have now come down to as low as 3 to 4%, which obviously is extremely low savings rate. I mean, just think about that for a second, right? $100 in income and only $3 is saved. Are you serious? That is absolutely crazy. So retail sales were flat in February after a sharp rise in January compared to a year back. Sales were up 7.9%. However, this right here was something that was posted by Charlie Bilio. Very, very good analysis, pretty much mentioning that U.S. retail sales increased 1.5% over the last year, the lowest growth rate since May of 2020 and well below the historical average of 4.8% after adjusting for inflation. The real retail sales fell 3.3%, which is the story, but the real story is far worse, and real retail sales fell 3.3% over the last year, the 7th consecutive year-over-year decline, and the combination of wages not keeping pace with inflation, record 24 consecutive months, and higher interest rates and credit card rates at record high of 20% taking a toll, U.S. consumer is pulling back. So that's the real concern here. That's the real analysis, which I think everybody needs to understand, is that we are seeing U.S. consumers now start to pull back as retail sales on a last couple months basis are negative. So we are seeing that decline. And that's one of the reasons why earnings are going to be extremely important for this quarter, which we are getting started with this week. And not only that, the guidance is going to be very important as well. What do these CEOs, executives actually foresee for 2023 in terms of consumer spending? That is extremely important for the market, because at the end of the day, that's really what's going to drive earnings for a lot of these companies, and as a result is going to drive the market. Now, as I mentioned in my previous sort of like earlier parts of the video, where what's bad news for the economy doesn't necessarily mean it's bad news for earnings or for the market. Now, that is true to some extent, because if we do start to see consumers pulling back substantially, and if that actually leads to a potential recession in 23 or 24, well, the Federal Reserve is once again going to look at that and really start to consider some significant measures of quantitative easing, which as a result will start to push the markets back higher, which is going to be very positive or bullish for the markets in that sense, because QE almost always is extremely positive for the market. So in that sense, we obviously can look forward to if that happens. But right now, as it stands, the economy certainly doesn't look the best, with the consumer spending also now starting to slow down, as we have seen with retail sales happen. And even in the surveys, people are mentioning that they are looking forward to saving more and spending less in the remainder of 2023. Now, this right here is also, that's really interesting. This is actually tracked by the Minneapolis Fed, so you can actually access this yourself, and this is market-based probabilities. And what this does is this pretty much takes into account the options data and pretty much the betting market, and prices in what the expectations are for inflation, for S&P 500, for a lot of different things, right? So you can look at CPI over 5 years, S&P 500 over 12 months. You can look at a lot of different, commodities and currencies and equities. Today, we're going to be focusing on CPI over 5 years, meaning that what is going to be that CPI rate over the next 5 years? What's the consensus based on options, based on the betting markets? And 2023, this is the most recent data, April 12th, is what we're going to plug in. And CPI, we're going to compare this to where we were same time, say 2 years ago in 2021. So CPI, and again, we're going to go over to 2021 here. And we're going to plug in April 14th, and we're going to hit show graph. So what this really shows you is that bell curve, and what it's suggesting is that 2 years ago, right? So go back to week of April 14th, 2021, the expectations for the median CPI over the next 5 years was dramatically higher than where we are today. So if you take a look at the median number, you'll notice that the expected CPI over 5 years back on April 14, 2021 was 2.58%, which has now been lowered. So we're now come down to 2.25%. So that is good. We're still not exactly at the Fed's target, but we are obviously much closer to the Fed's target over the next 5 years. That's what the expectations are from market participants. And if you take a look at the 10th and the 90th percentile, that's really what's interesting, is because those numbers have widened out, right? So what we're seeing is, if you take a look at this blue bell curve, you've got the lower percentile and the higher percentile, 10 and 90 percentile. We've got a much extreme levels have been increased on either direction, as opposed to a much narrow bell curve over here, which is in red, which is from 2 years ago. So that's the only difference. So over 5 years, the median estimates have come down, but the extreme levels have been pushed further out. So you'll notice that we've gone from 1.56% now down to 0.63%, which is good, right? So it's going to be under 1%. But on the higher end, it's actually gone from 3.76% to over 4.63% on the 90th percentile. So in other words, if we do see that extreme level on the higher end, it's possible that we sit at over 4.6% even after 5 years from now. So that is something to keep in mind. This is market probability density. And again, you can kind of see that for S&P 500 as well. So if you go over to S&P 500 in 12 months, and again, plug in 2023, plug in April 12th, and I also do S&P 500 over here over 12 months. And let's just go with 2022 and whatever that last month is, December. And that's what we're going to do, 2022. And the date, let's just go with 28th of December. So let's just hit show graph. And this right here is going to be the S&P 500 over 12 months from December 28th to April 12th, 2023, in the last three to 4 months, how the expectations have changed. And the median for the next 12 months is just under 7% as of April 12, 2023. Even as of December, the median was 6.3%, but S&P 500 right now is only up 6 to 7%. So there's not a lot of upside priced in for the market right now. And the bottom percentile, we're expecting negative 22.4%, negative 29.49% about 4 months ago, but right now we're sitting at 22.4%. And on the higher end, the 90th percentile, we're sitting at over 23%. And about 4 months ago, we were sitting at just under 28% at the moment. So bottom line is that, in my opinion, the U.S. economy is definitely going to have a turbulent times. There's going to be a little bit of a roller coaster ride between the U.S. consumer, the inflation, the interest rates. We're going to see how earnings play out this quarter and what the guidance looks like. But eventually, there's going to be opportunities, in my opinion. There's going to be a lot of potential deals out there to take advantage of if and when the markets does give us that opportunity, does pull back. And that's one of the reasons why the cash exposure for me personally is going up a little bit, so I can take advantage of those deals. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. As always, happy investing, and I'll see you all in the next video.